Hey, good morning, options traders, and welcome back, everyone. Another good question for the group. Is a gut iron butterfly better than a standard butterfly? And I've talked about this before in previous videos, but don't panic. We're not going to get into all of the details of these strategies. But my point is just to show you to always be careful when somebody tells you that one strategy is better. There is always a cost. And the better way to approach the strategies is to say, is it worth it for me to bear this cost? And it will also help you to identify the risks that you should be watching. So let's look at some of the details. First of all, gut iron butterflies will cost more than a standard butterfly. And the appeal is that you can only lose a small portion of your investment. And hey, who wouldn't like to have that benefit? But remember that you must always pay for any benefits. Anytime you hear the word benefit or advantage or characteristic that's desirable, there is always a cost to it. You're never going to get that for free. So you want to learn to identify where these benefits are coming from. So when it comes to butterflies, there are actually many ways to construct them. We have just a standard butterfly, and there we will use either all calls or all puts. So for instance, I might buy the 95 call, sell the 100 call, sell another 100 call, and then buy the 105 call. I could do this exact sequence by using puts, and we would get the identical graph. We can also use what's called an iron version. And anytime you hear the word iron, such as an iron butterfly, iron condor, things like that, it is a mixture of calls and puts. So perhaps we buy the 95 put, sell the 100 put, sell the 100 call, and buy the 105 call. So notice it's exactly the same numbers, 95 selling the 100 twice and then buying the 105, doing it exactly the same way here, but I'm just starting out with puts on the left-hand side and calls on the right. But now, if we use a gut iron butterfly, we're very simply going to switch the calls and puts. So we might have a 95 call, long, short the 100 call, short the 100 put, and long the 105 put. It's exactly the same strikes that we used for the iron butterfly, but there I put the puts on the left and the calls on the right. Now I'm putting the calls on the left and the puts on the right. So I'm not really sure where the term gut iron came from, but I believe it's from the insides, where we have this box position, kind of the innards of the butterfly, so to speak, that we're boxing in. And that's what's creating this ability for us to not lose 100% of our investment. So from a profit and loss standpoint, this is what a standard butterfly would look like. Maybe we buy the 95 call, sell 2 of the 100 calls, and then buy the 105 call. And if I changed these words right here, calls to puts, like that, we would get exactly the same risk graph, assuming there are no skews in the markets. But what else could I do? Well, I could buy the 95 put, sell the 100 put. Notice that I have the puts on the left-hand side. But as soon as I jump to the right, I'm going to sell the 100 call and buy the 105 call. Still the same strikes, but I've got puts on the left and calls on the right. This is an iron butterfly. But if I now switch them, I'm now going to put the calls on the left. So I've got a long 95 call, a short 100 call, and then when I jump to the right-hand side, I'm going to switch to puts. I'm short the 100 put, and then I'm long the 105 put. And once again, we should get exactly the same risk graph. So why is it with this version right here, this is the gut iron version, can we not lose 100% of our investment? And again, this is the big advantage that everybody seems to talk about with the gut irons and saying that it's better. Well, you're actually paying for it with a box spread. So if we look at a kind of a mock-up layout of a broker's platform, we've got calls on the left, puts on the right. Let's say we buy a 95 call and we sell a 100 call, and then we sell the 100 put and buy the 105 put. This is a gut iron. And what's giving you this box position, or the gut portion of the gut iron name, is the fact that we have the right to pay 95 and we also have the right to sell for 105. We're long this put. That's a $10 guaranteed return. And that's why we must pay more for it. So to show that we have in a sense, bought a box position on top of a standard butterfly, let's subtract it out. So I've talked about the box position in a previous video. To sell a box, we might sell the 95 call and buy the 95 put. This is a synthetic short position right here, one leg of the box. For the long portion, we might buy the 105 call and then sell the 105 put. This is our synthetic long. So this box position really doesn't count. It's just like a T-bill that's thrown into the position. But look what it does. It's going to cancel these, and it's going to cancel these, and what are you left with? You are left with a standard butterfly. We've got the puts on the bottom and the calls on the high side. So to see this in action, let's jump over to the Thinkorswim platform and see if it really works. Okay, so now we're into the Thinkorswim platform. I'm going to use Apple for the demonstration, and we have a risk graph for a butterfly, and we're going to use the 120, 125, 130 butterfly. So here are the strikes, and notice for starters, I have the puts on the bottom and the calls on top. So it's the 120 put, short the 125, and then we're short the 125 call and long the 130. So this is a standard iron butterfly. So what about the cost? Take a look at the prices here in green. These are the long positions. $1 plus 78 cents, that's $1.78. But we're going to receive $2.50 plus $2.30 or $4.80. So that is a credit of $3.02. And this is a short iron butterfly, which is always a credit. This is a short straddle right here in the center. And then we're just long a strangle. So it's going to be a credit. That's another reason that sometimes people get attracted to the iron butterflies. But at any rate, if we have a credit of 302, that would be our maximum gain. And because we have a $5 spread right here, that's the difference in the wings, we might actually lose $1.98. So let's jump up to the risk graph, take a look at the lowest portion, and look left. And there's your minus 198 bucks. It's $1.98 times 100 shares per contract. So that is the maximum loss. But now watch what happens if we switch these, if we do the gut iron. Let's put the calls on the bottom and we'll make the puts on the high side. We still get the same risk graph, but we won't necessarily get the same prices. Theoretically, we should. But let's take a look. Over here in green, we have 6 plus 6.15, so that's $12.15 that we have to spend. And we're going to receive $4.80. So this is definitely going to cost us $7.35. However, does that mean that's the most we can lose? Well, we have to account for the box position. We have the right to pay $120 and the right to sell for $130. So we have a guaranteed $10 coming back to us. So if we spent $7.35, we can receive $10. That is a maximum gain of $2.65. And because this is a 5-point spread, we could lose the balance of $2.35. So that should be our maximum loss. Let's go up and check it. We'll point to the maximum loss area and look to the left, and right there is minus $2.35. But think about it. On the previous one, on the iron butterfly, we had a max loss of $1.98. And now it's showing $2.35. So there's a 37-cent discrepancy in there in favor of the iron butterfly. This is the real reason that you want to pick one strategy over another, because this is quite common. You're going to get skews in the markets. And this is, quite frankly, why a lot of these strategies were developed. Not just because you think the stock is going to go sideways. It's to capitalize on these discrepancies. So how would you capitalize on that? Well, that's where your understanding of strategies will pay off. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.